break this down. Tamal Bandyopadhyay is author and senior journalist, our old friend here at ET Now, joining us along with Raman Aggarwal of FIDC. Both gentlemen, a very warm welcome. Raman Aggarwal, coming to you first. The RBI governor, like I was saying and sharing with our viewers, did flag off those concerns about the high growth in certain components of consumer credit and had asked banks and NBFCs to check this growth by strengthening their internal surveillance. Tell me if this was done, and do you think the RBI is justified now in tightening these norms on consumer loans?
Thank you for having me on the show. At the outset, let me first just clarify that the views which I'm going to share are my personal, because we at FIDC are still discussing how we structure this. So my views are personal, but yes, answering your question, see, while yes, this concern has been there that there is a rapid increase in the unsecured loan portfolio, although it has a substantial impact coming from the digital lending space. That is what part we need to keep in mind. However, we do appreciate RBI's concern. While the increase in risk weight for unsecured loans could be, going by the trends, may be taken as justified. But what we find very surprising element in this circular is that in addition to the increase in risk weight on consumer lending, all bank credit to NBFCs, the risk weight has also been increased. Now, that is something which has really taken us, at NBFC sector, by surprise. And I think that is where we find that NBFCs are going to be hit the most. Because on one hand, by increasing our borrowing from the banks, by increasing the risk weight will mean our cost of borrowing will go up. The overall lending quantum will be reduced. And on the other hand, our lending space, again, because of this increase in risk weight, the rates will go up. So I think the surprising element is the increase in risk weight on bank lending to NBFCs. That is something which we feel may not be justified, and it will have an impact.
What kind of impact Tamal thinks this could have on NBFCs? Tamal, you heard the point that Raman Aggarwal is making. This hike in risk weights on consumer credit exposure, it includes personal loans, but the norms exclude housing, education and vehicle loans, as well as loans secured by gold and gold jewelry. Tell us what you think about NBFCs and how impacted they would be because of this.
No, certainly, I think, I'm just a little surprised only on one, in one aspect, Vikram, is this. If you remember, Reserve Bank of India governor during the post-policy conference, he pointed out that, the unsecured loans have been outlier, going at 23%, etc., etc. But at the same conference, Swaminathan, Reserve Bank of India deputy governor, he ruled out that any regulatory prescription such as increase in risk weight was considered. That is, I'm talking about in October. Now, what exactly happened in the past 6 weeks, that has prompted the Reserve Bank of India to come with this new norm. I don't have any, absolutely, I think this is the way, this is the right way to go, the risk weightage, adding it to it so that you make capital more expensive and discourage them, the lenders, to give low unsecured loans as well as the borrowers, because the cost of money will go up. But what exactly happened in 6 weeks? Why not during the policy itself? Something we are missing out, or RBI is convinced now the bankers are not hearing the warning, they're not paying attention at all. Because if you see, this is not the first time RBI spoke about it. Even this RBI financial sector stability report, which is a half-yearly publication on the financial sector. The last was in June, and they spoke about the unsecured loan, retail loan growing 25 to 25.2% in March 2003 versus close to 23% in 2001. And whether the secured loan is going down. And it spoke about also, even before that, there's another Reserve Bank of India publication, which is report on trends and progress in banking. That's in December 2022, 1 year back. This is warned of the retail loans coming as a systemic risk. So about close to a year now, RBI has been keeping a very close tab, and finally it has come out. Now, I'll not take more than a minute. Just two things I want to point out. This is the second time in the recent, not so recent past actually happened, Dr. Y.V. Reddy followed the same rule in the run up to the global financial crisis 2008. In 2005 and 6, he did raise the mortgage loan, because that was the time when FDI opened up and there was madness in terms of giving mortgage loans. So RBI first raised it to 125% and then even 150%.
Right.
And RBI also did, Dr. Reddy was the architect of that, also did raise the consumer credit again from 100 to 125%. So that's how he could shape the system at that point of time. Now, of course, financial stability is not threatened that way, but it is the right right option that RBI has taken. Yes. And finally, you also need to take what is the credit bureau data saying. I'll just quote the two credit bureau data. One is credit high mark. It talks about delinquencies, which is loans not been serviced between 30 days and 90 days.
Yes.
For the 50,000 up to 50,000 loan, it rose to 8.1% in the June quarter.
Yes.
That's the credit high mark bureau data, and other data is the TransUnion civil data, which is absolutely you can see it's sensational.
Yes.
The over leveraging. They are saying that in the June quarter of FY24, 51% of the consumer who availed of the small ticket loans already had more than 4 credit products in their credit.
And that's the problematic area.
Of these loans are
that's the problematic area,
budget.
Tamal. NBFCs that Raman Aggarwal is pointing out, we're talking about the small ticket loans. The RBI did point out that credit growth in these unsecured loans had been an outlier at about 23%, like you said. But it is about those smaller loans, and that is the problem area where, the RBI was particularly concerned when it came to personal loans of up to 10,000 rupees that would be ordinarily taken for 3 to 4 months. How potentially damaging is that, Raman Aggarwal, in your understanding, since you highlighted and flagged off the impact this would have on NBFCs?
See, as I said, while all points taken, and we do not debate on the point that perhaps, yes, this was an area of concern. Increasing and the increase in risk weight has been done uniformly for banks as well as NBFCs. My point again is, why increase the risk weight on bank lending to NBFCs? That is something which is surprising. While our lending weight, the risk weights have gone up, absolutely fine, going by the market scenario and going by the concerns highlighted by the governor and what Mr. Tamal just spelled out. That's absolutely fine. But why do it for NBFCs? That will have an impact. And there is one more technical point in the circular, if you read. It says that all top-up loans, even against the movable assets like vehicles, will also be treated unsecured. Now, technically speaking, let me put you a practical example. Suppose there is a vehicle whose market value today is 5 lakhs. Or suppose it was a new vehicle which cost 7 lakhs. The NBFCs gave a loan of, say, 75 or 80%. So after about a year, the exposure has come down. The market value has also maybe changed. And the NBFC gives the top-up loan. But if the overall exposure is still below the market value of the asset, technically it would be incorrect to treat it as an unsecured loan. So to have a blanket provision and say that all top-up loans, even for vehicles or other assets, will also be treated as unsecured, to my mind is again not only unjustified, maybe technically incorrect, if the market value of the asset still covers the overall exposure.
Yes, you would have preferred a more nuanced kind of approach, especially to safeguard the interests of NBFCs, Mr. Aggarwal.
Let me also point out, Vikram, one more point today. While RBI has increased the risk weight on the lending or riskier segments,
yes,
unfortunately for NBFCs, even for low-risk lending, the risk weight is blanket 100 across all sectors.
Correct.
That is surprising.
Right. We'll have to leave it there because we're running out of time, but this is an interesting discussion, and of course, it's going to impact the credit business across the country when you talk about unsecured consumer loans, and we'll keep tracking that. But Tamal and Raman Aggarwal, many thanks for joining us with your perspective on this tonight.